Inflation is an important macroeconomic issue because it affects the cost of living and overall economic stability. Inflation refers to a general increase in the prices of goods and services over time, which reduce consumers' purchasing power. In Malaysia, inflation is measured using the Consumer Price Index or CPI, which tracks price changes of commonly purchased goods and services. When inflation persists for a long period, it can create uncertainty in the economy and negatively affect households and businesses. Therefore, controlling inflation is one of the main objectives of monetary policy. This responsibility lies with the Bank Negara Malaysia or BNM. Through monetary policy, BNM aims to maintain price stability while supporting sustainable economic growth. The Monetary Policy Committee, known as the MPC, set monetary policy decision. One of its main tools is the Overnight Policy Rate or OPR. The changes in the OPR influence interest rate, borrowing, consumption and investment. Through this measure, BNM manage inflationary pressure and ensure overall economic stability in Malaysia.
Next, move to the tools by monetary policy. The first one is Overnight Policy Rate, OPR. OPR is a policy that influences deposit rate, bank lending, and financing rate. The rate tells how much a deposit return or a loan interest. A duration of OPR is determined by economic conditions and market expectations. And the purpose of changing OPR is to bring best performance. And if the economy grows slower, OPR downward to encourage more investing and spending. While if the economy grows higher, OPR upward to protecting economy from overheating. The second one is Statutory Reserve Requirement, SRR, which is a policy tools for managing liquidity and credit creation. Financial institutions must maintain balance in their SRA equal to special proportion of their EL, which is known as SRR rate. SRR may be raised to manage the massive buildup of liquidity that may cause financial imbalance and risk.
There are two main types of monetary policy, expansionary and contractionary. First, expansionary monetary policy is used when the economy is slowing down or experiencing a recession. In this situation, the central bank lowers interest rate and increases the money supply. This makes borrowing cheaper, encouraging consumers and businesses to spend and invest more. As a result, economic activity increases, which helps create jobs and support economic growth. In Malaysia, Bank Negara Malaysia may apply expansionary policy when inflation is low and economic growth is weak. On the other hand, contractionary monetary policy is used when the economy is growing too fast and inflation is high. In this case, the central bank raised interest rate and reduced the money supply. Higher borrowing costs discourage excessive spending and investment, helping to control inflation. Bank Negara Malaysia used contractionary policy to cool down the economy and maintain inflation at a manageable and sustainable level.
Next, real example in implementing monetary policy in controlling inflation. On 11 May 2022, Bank Negara Malaysia decided to raise the overnight policy rates by 25 basis points from 1.75% to 2%. This decision is due to the globally inflationary pressure caused by the increase in commodity prices, disruption in supply chain, and strong global demand, particularly from the United States. At the same time, it was supported by the continued reopening of the global economy and the recovering Malaysian economy, which is strengthened by strong domestic demand and improving labour market conditions with lower unemployment rates and better income prospects. This condition indicates that the economy was strong enough to support a policy rate increase while maintaining price stability. This increase in the OPR rates demonstrates how Bank Negara Malaysia in controlling inflation in our country.
Next is lowering interest rate in Asian financial crisis. When crisis struck Thailand, the wave speculation of ringgit weakened as low as 4.88 ringgit per USD dollar and stock market price dropped by 70%. And Malaysia did listen to IMF recommendation to increase interest rate, but is still unable to stop the speculation. And as a result, Malaysia decreased the interest rate back the same before the currency attack. Malaysia also pegged ringgit 3.80 to US dollar as a solution to bring back stability, and it helped to increase competitiveness at export industry by fixing the currency and trade becoming more stable. Additionally, government managed to overcome the effect of reduction interest rate and implemented selective capital controls at 1998. Capital controls are a measure taken by a government or central bank to regulate outflow or inflow of foreign capital, and it helps to lower risk, relieve pressure, and allow decision makers to put recovery plans into action.
These are the two graphs that prove about the lowering in interest rate exchange financial crisis. The first one is about the exchange rate. The line on the graph shows that how ringgit Malaysia falls from 1997 to 1998 at the peg at RM 3 ringgit 80 cent. This graph clearly highlights how the peg reduced the volatility successfully. The next one is the graph that shows the foreign direct investment trend. Malaysia have a very good FDI before the crisis happened. Unfortunately, it came to reduce of the FDI drastically during the crisis in 1997 to 1998. This will affect the foreign investor whether they will withdraw their investment or not. After that, FDI increased again when the crisis came to an end.
Next, challenges in a monetary policy is firstly, when interest rates stay low for the long time, people and firms tend to borrow and spend early than they should. Over the time, this causes debt to build up among households and the business and push leverage to the very high level. As more income is used to repay the debt, future spending becomes limited, which make further monetary policy less effectiveness. Furthermore, when interest rates are close to zero or negative, central bank risks falling into a liquidity trap where the lower interest rate no longer encourages borrowing or investment. In that situation, banks may become more cautious and tighter lending standards due to higher risk, which weaken the transmission of monetary policy. Finally, when monetary policy stay loose for too long, it keeps inefficient zombie firms and weaker banks alive even though they are unproductive. This stops resources from moving to better, more innovative firms, slow productivity and innovation, reduce potential output, and make the economy less responsive to the further monetary stimulus.
Next, we move to the importance of monetary policy. Price stability and output are one of their importance. Effective monetary policy will help to stabilize the price and output. In short run, because the price does not adjust immediately, changes that happen in money supply will influence the goods and services. Central banks conduct monetary policy for this reason. Monetary policy is important to ensure the price and output are in good condition, which are stable. Monetary policymakers should balance the price and output wisely. Central banks that only target inflation will admit that they give attention to the stabilization of output. Central banks also keep economy near to full employment. Other than that, it is the objective of central bank which is stabilizing the price and output. Central banks implement the monetary policy using money supply, interest rate, and others to control price and output growth. This is known as common practice to evaluate the central bank's performance to achieve targets. To make sure it can be achieved, there is a lot of monetary policy framework that they have been used depending on their country's environment. Thus, it plays an important role in the economy. Tight monetary policy can help to control inflation and stabilize the price wisely.
Next, the importance of monetary policy is support economic growth and employment. An effective monetary policy creates a stable financial environment, fostering sustainable long-term growth measured by GDP and overall production of goods and services, and it affects employment. When Bank Negara Malaysia implement an expansionary monetary policy by lowering interest rates, borrowing becomes cheaper for business and households. This encourages firms to invest in new projects or expand production, while households increase their spending, and it further boosting aggregate demand and employment. On the other hand, a contractionary monetary policy with higher interest rate, increased borrowing costs, and reduced investment and consumer spending, which slow down the production and leads to the higher unemployment. In this way, by adjusting interest rates, monetary policy encourages job creation and support the growth of the economy.
In conclusion, BNM play an important role in keeping the economy stable through monetary policy, mainly by using OPR to influence interest rate, liquidity, and economic activity. By using both expansionary and contractionary policy, BNM control inflation and encourage growth such as OPR high in 2022 to manage rising inflation. However, if the policy is too tight or too loose, it can create problems like a weak investment and financial instability. Therefore, BNM must carefully balance short-term economic pressure with the long-term stability.